There is a three-digit number that controls almost every major financial decision in your life: your credit score. It determines whether you get approved for a mortgage, what interest rate you pay on a car loan, and even whether a landlord will rent to you. Credit score is a numerical summary of your creditworthiness. It tells lenders how likely you are to repay borrowed money. The most widely used model is the FICO score, created by the Fair Isaac Corporation. About 90% of top lenders use FICO scores to make lending decisions. FICO scores range from 300 to 850. The higher the better. Scores below 590 are considered poor. 580 to 669 is fair. 600 to 739 is good. 740 to 799 is very good. And 800 to 850 is exceptional. The average FICO score in the United States is about 715, which falls in the good range. But what exactly determines where you land? Your FICO score is calculated from 5 factors. The single biggest factor is payment history, which makes up 35% of your score. Next is amounts owed at 30%, length of credit history at 15%, new credit inquiries at 10%, and credit mix at 10%. Payment history is the most important factor because it answers the most fundamental question: do you pay your bills on time? Even one missed payment can drop your score by 100 points or more. Late payments stay on your credit report for 7 years. But the good news is their impact fades over time. A late payment from 5 years ago hurts much less than one from last month. The second biggest factor is credit utilization, how much of your available credit you are using. If you have a $10,000 credit limit and carry a $3,000 balance, your utilization is 30%. The golden rule is to keep utilization below 30%, but the best scores come from keeping it under 10%. Maxing out your cards is one of the fastest ways to tank your score. If you are starting from zero, here is how to build credit. First, get a secured credit card. You put down a deposit that becomes your credit limit. Use it for small purchases and pay in full every month. After 6 months of on-time payments, you will start building a score. Become an authorized user on a family member's card and keep your accounts open as long as possible. Let us bust some common myths. Myth 1. Checking your own credit score hurts it. Wrong. Checking your own score is a soft inquiry and has zero impact. Myth 2. Closing old credit cards helps your score. Actually, it usually hurts because it reduces your total available credit, which increases your utilization ratio. FICO is not the only scoring model. VantageScore, created by the 3 major bureaus, is an alternative. While they use similar factors, VantageScore weighs them differently and can score people with thinner credit files. Now here is where it really hits your wallet. On a $300,000 30-year mortgage, someone with a 760 score might get a 6.5% rate, paying about $683,000 total. But with a 620 score at 8%, you would pay $793,000. That is a $110,000 difference just for a lower score. To improve your score, start by paying every bill on time, pay down high balances, do not close old accounts, limit new credit applications, and check your credit report for errors. Dispute any mistakes you find. Here are the key takeaways. Payment history and utilization make up 65% of your score. Keep utilization under 30%, ideally under 10. Never miss a payment. And your credit score is not just a number. It is a key that unlocks better financial terms for everything you do.